Good evening, good afternoon, good morning to some of you. Welcome to this PRI Digital session on listed equities for the next 10 years. My name is Michael Bartek. My background is in fund management. I'm responsible for leading the development of content on listed equities at the PRI. We have 4 distinguished panelists with us today, but before I introduce them, I would like to remind our audience that you can submit questions for the panelists using the relevant function on your screen. We will then try to address at least some of those questions towards the end of the session. So, turning to our panelists, so we have Hervé Guez, Chief Investment Officer at Mirova Asset Management, based in Paris, with more than 2 decades of investment experience, initially in the fixed income space, and for more than a decade now at Mirova, which is part of Natixis Group, where he built responsible investment teams.
Yes.
Our second panelist is John Quealy, the CIO of Trillium Asset Management. He's based in Boston. He spent many years as a provider of ESG services to asset managers and now manages responsible investment teams at Trillium. Our third guest is Carolina Minio-Paluello. She's the Global Head of Product Solutions and Quant at Schroders in London. And while her background and speciality is in data and quant analysis, she actually works very closely with the Schroders teams that use fundamental investing approach. She provides insights and information into their fundamental investment processes. And we also have Laura Starks, professor at the University of Texas at Austin, McCombs School of Business. She also has a wealth of experience. She actually developed one of the first ESG courses more than a decade ago. She's also advised the Norwegian Ministry of Finance on responsible investing in their sovereign wealth fund. And she has for over 15 years been on the board of a mutual fund. In fact, it was one of the earliest entities in the US to offer an SRI fund. So I hope you will agree with me that we couldn't have wished for a more distinguished group of experienced and successful panelists. Now, the concept of ESG investing in listed equity space is definitely not something new. A lot has evolved, a lot has changed over the last 10 to 15 years, and ESG integration in some form is now very widely used. So, turning to the panelists, my question would be, do you agree that the job is done and that there is little else to do? Hervé, can I start with you?
Yes, thank you, Michael. If we speak about awareness, if we look at the number of PRI signatories, if we look at the number of institutional investors and asset managers that are talking about ESG, if we look at the number of funds that declare themselves as integrating ESG factors, etc., yes, the job is done and maybe overdone. But of course, there is a big but. Everybody talks about ESG, but nobody agrees on what it really means. So nobody agrees on what should be the narrative. When I speak about narrative, it is mainly why should investors take care about ESG and what could they expect from an ESG investment. There is no common objective on ESG. ESG integration versus impact investment. And there is, of course, no consensus on what environmental and social outcomes mean and how we measure the outcomes. Because, of course, if we do not have the same narrative and the same objective, it is difficult then to create a consensus on that. So from this perspective, yes, everything has still to be done on ESG.
Great. Well, thanks very much for that. Can I now turn to John to answer that question?
Sure. So I'll take a little bit of a different approach. I will say and agree with the consideration of non-financial factors into the investment process, and you can characterize that in some instances as ESG. It is becoming more common, as Hervé was talking about. I will say, I think the work is not done. For example, there are no forward estimates for any asset service provider, asset manager. For those of us that are fundamental, we're looking forward. We're looking to pick stocks. Those are all about future expectations, not only in our cash flow models and our fundamental models, but in our ESG models at a specialist firm like ours and others on this call. So I would say that no, in fact, there's plenty more, let's call it mechanics, that needs to happen in the listed equity space to have this be on an even footing with fundamental or quant investing. There's still a fair rubric need to be built.
Thank you very much, John. Carolina, do you have a similar or different view?
Similar view, but maybe I'll go a little bit further, Michael, because ESG integration is very widely talked about, and now regulations are asking us to demonstrate what we're doing. But I would almost say to you that we are starting in a new journey, because if you go back 20 years, when we're looking at our portfolios, alongside the returns, we introduced the dimension of risk. Today, this dimension of risk is expanding to incorporate the impact that companies have on society. And so really the social impact that companies have translates into a financial cost for companies because of regulation. So in summary, I would say that what we today have to do is really understanding this third dimension of impact, how we balance it along risk and returns. And we're really getting started. That's why we had to build our own proprietary tools, because the narrative, the tools are very different. So we had to build our own tools to really understand better this expanded dimension of risk. So it's the beginning of a new phase, Michael.
Okay, thank you very much. Can I turn to you, Laura, for your take on this initial question on whether it's all done or not?
I think that we have, as everyone has already said, I think because of different definitions of ESG, that we have a lot of different approaches that are being used, and we don't know, which approach is the best approach. We also have the differences in motivation for ESG that are creating different demand and different approaches. There's some that want it because of their tastes and preferences. There are others that want it because of the return opportunities or the risk mitigation, and then there are some that have both motivations. And so I think that because of these differences, I expect there to be a lot more evolution in ESG investing and the different approaches that are being used.
Okay, thank you very much for those answers. Now, the next thing I would like to ask about is, in a way, evolving out of that initial question. So, my question really is, how do you think will ESG incorporation actually evolve in listed equities investment decision making? And on a related note, how will or should ESG factors influence, capital allocation within listed equity portfolios over the next decade? And maybe we could start with, Laura.
Okay, so we talk about ESG as if it's one central quantity, the one score will reflect on firms. But I think what we really need to do is to drill down into each of these separately: environmental, social, and governance. And even within each of those, there are separate aspects that need to be considered in order to have more meaningful analysis and understanding a company's activities and the risk, the exposure that they're having because of these activities. I think this is particularly important given that companies are so different in their ES&G activities. Some are much better on the E, others are much better on the S. And governance has been investigated for a long time by investors, but the E and the S are just now starting to come. There's also new issues that keep arising, such as cybersecurity, which is both, actually it's all three. It's an E and an S and a G concern. And so the question is how to look at what firms' activities are with regards to the new issues and how they relate to ESG.
Okay, thank you very much. John, can I turn to you now?
Sure. I guess I'll put a finer point on my introductory answers to your question. So to give you a little bit of my viewpoint, so we're long only diversified equity investors. Certainly we have longer holding periods, and so that's where our frame of reference comes from at Trillium. So you should know that as I'm answering this question. But first of all, from a fundamental lens, we're constantly looking forward. We don't see a standardization in forward estimates for a company. Think about the inherent incongruency. Financial data comes out quarterly or biannually, depending on the domicile of the company. ESG data is in many cases not required, or if it is, it's not reported for the most part on that cadence. So we need to have a matching principle. It's kind of like balance sheet analysis or cash flow analysis. We need to bring everything back to the present value. The ESG data industry now is not set up for that. Asset managers, many, are not set up to ask that specific question. What are you trying to achieve in this portfolio? What are you trying to achieve with this asset allocation and this stock selection? And I think maybe Laura said it earlier, or maybe Carolina, very, very nicely. What sort of impact do you want to make here? These questions have to be answered, but right now the frameworks are not even being talked about in a way that we feel would be authentic around ESG integration being complete, or ESG integration really being meaningful to, let's say, a fundamental portfolio manager that didn't grow up in this industry. Many of us did, but many new faces are taking this for the first time. How do they think about it? So I'll stop there and let others comment.
Okay, thank you very much. Maybe I could turn to you, Hervé. What are your thoughts on the actual ESG integration development over the next decade?
Yes, clearly, I think that the answer to the question depends on the kind of products or objectives you develop. If I may, maybe it's too simplistic, but let's categorize 3 different investment objectives that you want to address. You have a lot of products that do not want to achieve any alpha. They do not search for outperformance in the market. They just want to allocate. You want to duplicate the performance of a benchmark, should it be MSCI World, Europe, or other indices, etc. In this case, the rationale for ESG integration would certainly come through engagement. So rather than kind of outcomes, if you want to integrate ESG factors within your investment decision, if your principal objective is to duplicate the performance of an indices, you will go for engagement. And so the question then will be, what are the outcomes of engagement? On what should I engage? How should I report, etc., etc. You have another approach with, I'm only looking for alpha. My only objective is to deliver the better performance within a certain time frame to my asset owner. So in this case, ESG you will look at ESG as what are the factors that are financially material within during my investment time horizon. So climate change, okay, certainly for utilities, it is something that is important. Should I collect data on climate change if I look at a media company? Maybe not. So if you are only looking for alpha, the rationality is, okay, it's a new environment. I had to better understand this environmental, this new sustainability issue, and to better integrate them, because I need to better understand the company I invest in. I look then to do better calculation, etc. But I would say then business as usual is just good investment, as it has always been. And there is a third way to integrate environmental and social issue, is to say my investment process should deliver alpha, but it should also deliver environmental and social quality, environmental and social impact. And here, what I want to integrate, what I want to collect, is not only how sustainability issues affect the company I invest in, but how companies that I invest in affect the society, and then how should I integrate within my investment decision my capability to allocate capital towards companies that will help to address sustainability issues. And if you do that, clearly the kind of ESG data that you are going to collect and the way you want to integrate this will be very different to the previous when you are looking at only alpha. And clearly, in my opinion, so let's call this third way to integrate ESG as impact investing. I'm really convinced that this is that impact investing is the future of ESG, of sustainability investment. More and more, the demand will be not only do well your job and understand the company you invest in, but do well your job and make sure that you allocate capital in a way that it helps economy toward a sustainability path.
Okay, thank you very much for that. Can I turn to you, Carolina, for your thoughts on this?
Thank you, Michael. And actually, my comments are not that dissimilar to Hervé, other than I probably will not touch on the more index investing. But if I go back to, I would say, Hervé's category 2, this is what I would call the sustainability type of strategies. And for us, is really understanding the risk, as I was telling you before, and it's really investing in the transition, right? And it's really the job, as we always do, and understanding the additional dimension of risk, understanding which companies are likely to transition and which are not. And that's where not only we build our tools, but also that's where we can engage with companies to effectively, using our data, understand, which one are likely to make it or not. And this, I would say, understanding this dimension is part of our fiduciary duty, and this is something we have to do and will continue to evolve. And that's really where we can influence the companies we invest in. But what is really important is that an increasing amount of investors, and this is actually across all the different regions, right, are starting to say it's very good that you understand the risks and invest in a transition, but we want to have an impact with the assets that we have. We really want to contribute to a solution. And that's where the Sustainable Development Goals, the SDG framework, becomes very relevant, because they talk about more and more about what they want to solve for, where they want to contribute. And at the end of the day, the SDGs are 17, but if we think about what the clients are telling us is contributing to the climate challenge and thinking about diversity and inclusions. And of course, when they ask us to do that, we will look at reducing the universes, because we need to invest in companies that not only are transitioning, but also are contributing to that point. And of course, the universe will be, of course, smaller, but will reflect the impact that they're asking us to do. And what is interesting there is that this is where you enter the world of the kind of thematic SDGs, and that really adds into already the trend of thematic investing, which is increasingly important in portfolio constructions as opposed to countries and sectors exposures.
Okay, thank you very much for that. Maybe I can ask sort of a follow-up question, but maybe from sort of a maybe taking a sideways step to some extent. I just wonder. To what extent does the evidence case for incorporating ESG into listed equity investment decisions need to be strengthened? To what extent are we beyond the point where we have all agreed that, yeah, it's got to be done. It works. We just got to think about how best to do it. So maybe I could turn to John.
Yeah, sure. So there is a full suite of academic data. When we talk about this, Michael, in the question of ESG risks and opportunities, the data suggests in the attributions the risks are quite well managed. To risk jargon on this call, the defendability of downside capture, et cetera, and any related risk metrics are quite strong for ESG. That makes sense intuitively, right? Companies and management teams that are aware incorporate characteristics of ESG into their management process, show attention to detail, show risk aversion, just like they would be for product management and other things they do. So that is intuitive. On the alpha side of the equation, that gets into a more interesting question. Why does company XYZ, how has it moved 80% in the last year or two? What were the prime drivers? Was it purely fundamental, financial, or was it potentially a massive shift in human capital management that incentivized their workers? Is it, in the case of technology companies, so many of us are invested in large technology companies, what are they doing around climate? We only have one out there talking about carbon negative, and they use a lot of electricity around the world. So I would say alpha still needs a little bit more work, but the body of research we've seen does show the correlations, especially in risk reward.
Okay, thanks for that. Carolina, would you like to add anything to that?
Yeah, I'd say as a quant, right, you can imagine that anything we say needs to be demonstrated. So, over the years, I spent a lot of time looking at the relationship between ESG data performance. And I have to be honest, up until 2015, you can look whichever way you like. But if you do the test properly, you will not find any relationship. It's really only after that, after the end of 2015, that you start seeing some sort of relationship. And in reality, what happened there, it was COP21. It was when the UN came out with the Sustainable Development Goals framework. And from that point, there's been a kind of an awareness that something was happening, that climate change was a risk. And so from that point, you can start seeing there is somewhat of a relation, in particular when you look at ESG characteristic around climate, carbon footprint. But like John is saying, the relationship that you find is very much more on the downside protection, right? You'll see that the bad ESG companies tend to underperform. And so I would say it's not enough to actually construct a proper quant model, but it was definitely interesting to put this data in front of fundamental portfolio managers, because once they realized that this information, that data would help them to protect the downside, they would just say, well, if I can manage my downside, this is actually also understanding the opportunities for making money out of the investment. So it's definitely been very helpful, but I would say today is very much a question of how we understand it, as opposed to trying to be too clever with the data.
Okay, thank you. Maybe I could just quickly turn to Hervé, if you have anything to add regarding the evidence in favor of ESG integration. If any thoughts you have, please share those with us.
No, I think everything has been said.
Okay, and from the academic perspective, what is there to be done, Laura? Do you think when it comes to enhancing the evidence?
Oh, I think there is much to be done, and as Carolina talked about, we need the data. In particular, as John pointed out, the evidence that we have so far is much stronger for risk mitigation, and particularly the downside risk mitigation. And I think that one thing that we've been finding more recently has to do with engagement by investors, and how the engagement is affecting the risk exposure of the firms. And my own research, we find that engagement by investors has affected the downside risk of their investments. So I think there's a lot more to be done. I think it would be great if anyone would like to help us by giving us more data, and the PRI has been particularly helpful in that.
Okay, now since we are talking about data, what was interesting is when John suggested that maybe there should be a lot more forward-looking data out there. And I would be keen to find out what Carolina, you and what you, Hervé, think about the issue of forward-looking data to supplement what's already out there.
Michael, I think this is a great question, and that's why we had to develop our proprietary data, right? And so if you think about how we're going about understanding those risks, we have our ESG team, which is really an academic approach to assessing really the impact on society of a number of factors. But at the end of the day, we then want to figure out when will this social impact will hit actually the performance. And that is where it's really a nice combination between academic work and actually a fundamental analyst that really work hands in hands to then put kind of a judgment or an assessment of what is the likelihood that this cost will come into being reflected in the price today. And so that is how we're building ourselves on how we use this data, bringing more of a forward-looking assessment. And that's why we have to spend quite a lot of time getting the combinations with our fundamental teams.
Maybe here I will have a different way to put things. I think we should not expect too much of data in general. When we speak about climate change, biodiversity, pollutions, human rights, etc., each time you look at a company, you can certainly expect that a specific company in specific area, in specific geography, has certain way to measure and certain objective. But I think it could be an illusion to think about there is common data in every sector, everywhere. So we could have forward-looking data. It makes sense only if it's fit with the business model, the geography, the sector of the company. The second point is there is somewhere where we should have a common data, and forward-looking data is on climate change. Because on climate change, you have this magic currency, which is the equivalent ton of CO2. And when we look at, so here there is, you can say everywhere in the world, whatever it's your business model, CO2 at the end of the day is CO2. And even here, we are not yet capable to agree that how we should measure the carbon footprint of company. Scope 1, Scope 2, Scope 3, should we measure carbon avoided? So let's fix this. And then we could ask, okay, what is your forward-looking data? Because if we go too fast, then you will have a lot of companies saying, as it is currently today, they will say, we are going to be net zero. And this is my forward guidance. But what net zero means, on how it is measured, what is the scope, and is there a consensus on the way we should measure climate change? It's not yet done. And this is just the example on climate change. But if we come to biodiversity or human rights, which kind of data are we going to expect? So I'm convinced that within sustainability investment, there will be still a lot of qualitative analysis that has to be done. And qualitative analysis is not a bad thing, is not a bad box. There is a lot of investment decision that we are doing on financial side, which is based on qualitative analysis. You have some data, but at the end of the day, do you believe in the strategy of the management? Is there the right barriers on entry barriers, etc., etc.? There will be still a lot of qualitative analysis. And when you do qualitative analysis, you rely on current data. You are asking questions to the management on what are their objectives, and then you have an opinion, and you can decide on what you are going to do with this company. But the answer to better integration of ESG, I think, will not come only to better data and forward-looking data, etc.
Okay, I understand. Yeah, so we will come. Thanks very much for that. We'll come on to sort of reporting and data and metrics again later in this discussion. But thank you for those answers. Just like to move on to the next item I want to ask about, which is basically financial products. Financial products in the listed equities space. What are your expectations to what we are likely to see over the next decade when it comes to new products? Maybe to help finance transition to net zero, or maybe improve sustainability outcomes or meet SDGs. What do you think are the sort of things we're most likely to see based on or related to listed equities? Can I start with John?
Sure. To sort of touch upon something that was said earlier, I think we're in certainly an apex of, in some cases, ESG being overdone, actually, in traditional products. And so first we need to let that settle, let true committed asset management and asset owners settle themselves out. Right now, I think there's probably a little too much labeling going on. Well, you see it in the EU with the SFDR and the taxonomy coming to have all of us prove and state our assertions around impact is what we do at Trillium on all of our strategies. Even in the US here, with the SEC finally getting a bit more active around this. So that's the first thing, Michael. I think where we are in the hype cycle for products is probably a little too eager right now. But I will say, back to integration, it should be considered in most products. Certainly there's some currency bits, there's some very exotic derivatives and things which are very, let's call it technocratic, but we're seeing it now, actually, municipal securities in the United States, a very huge pool of client assets that really hasn't undergone any significant scrutiny in a systemic way around ESG. Quite frankly, a difficult proposition to do, even for those of us that have been doing it for years and years. So maybe a little bit more on the credit side. Maybe less climate bond, less green bond that's already up and running, a little bit more, wait a second, how do we integrate with G in the government side? But I would say it's open season for certain folks to generate products. The question is, do they have intent? Do they really have we call it a telos? Do they want to get to the end of an impact? I'm not so sure a lot of products do that.
Oh, thank you. Can I turn to you, Laura, about and ask about your thoughts on what we can expect in terms of products based on listed equities in the upcoming decade?
So that's what I think is so wonderful about the finance industry is this innovation, constant innovation, trying to meet investors' needs. And I think since you said with listed equities, because I'm so tempted to talk about the blue bonds, social bonds, and just to make one more point about bonds is the bonds that are linked to ESG metrics are becoming more common, and to prove that firms, and this will relate to their listed equities, but to prove that the firms will actually follow through on their ESG promises. I believe there'll be more specialized ETFs coming. and in a way that, and Carolina kind of talked about this idea that retail investors need to be more specialized, and their financial advisors are looking for products that help them reach the specialization that they want. And so I think there are already a lot of clean and energy ETFs. I think we'll see more social related ETFs coming, as well as, again, more that have to do with climate risk. And I think we'll see, as has been happening a lot, there's going to be a lot more active ETFs that are related to ESG goals.
Thank you for that. Carolina, I know you've touched on the idea of thematic investing earlier. Is that where you would expect to see most of the activity when it comes to product launches, product positioning?
Yeah, I think, Michael, if we go back to if we stay for a second on the net zero ambition, which is effectively, from a client perspective, the number one question that our clients are asking us to solve. If I stay in a listed equity at the beginning, I would say that what is effectively investing in the transition, the sustainable strategy, because the climate change risk is one of the most important. Ultimately, we're investing in companies that are transitioning. So as a consequence, Michael, the portfolios are reducing the carbon emissions. And I would say that this is becoming almost a norm. So today, I would say investing in a transition will become kind of the route to stay in the game. So where I expect the new product offerings and demand to come is really in the thematic. And so if you think about always staying on the net zero, is very much entering into climate mitigations. And so in listed equities, you will talk about strategies that invest in companies that are solar, wind, waste management, positive nature investing. So it's really companies that contribute to the solution. And that's where we're seeing a very increased amount. Now, the caveat on that is you make it hard for us because you say listed and you say equities, right? So when you invest, you don't know exactly where the companies are going to do with this money. And so it's a question of estimation. And that's where, again, for us, the work has been to really estimate the impact that companies have. And as was mentioned, of course, in the fixed income, you will have the green bond, the social bonds, which, of course, don't have the market is not that big, but at least you know where the proceeds are going. And then, of course, you open up to the private asset space and, of course, the natural capital preserving the carbon sink. So I would say that the investor increasingly look at the full range to be able to kind of solve the problem. And Laura, I completely agree with you. The next step is the social, the inclusion, and what we're seeing is more and more the kind of climate related and the social are becoming closer and closer. But it's a question of then demonstrating to the clients that this thematic journey is really aligned. It's not like a marketing saying we do that and you get away with that. It'll be really important to demonstrate what effectively those teams are doing and how they're contributing, as Hervé was saying earlier on.
Yeah, thank you for that. Hervé, do you have any thoughts on the product offering?
Yes, I fully agree with what just has been said by Carolina. Maybe if I will complement what she has said, I would say probably we'll have a lot of innovation on impact investing, and probably what we could see in the future is not only funds that address global issues, but also funds that will address local issues on specific social issues, or even sometimes environmental issues. So for the time being, we are mainly focusing on environmental issues and climate change, and I think more and more we'll see that there are some issues that it's difficult to address, let's say, a social issue with the same product in every country. And if you want to address, for instance, the employment which is an important issue in France, unfortunately, probably you will need to develop a specific product for this specific distribution network. The second, maybe the third area where impact investing globally, local subject and with local product, and probably the third area where I imagine there will be a lot of innovation is that for the time being, we have seen engagement rather at the level of the asset management company, at the institutional level. And I think it would make sense to develop engagement at the product level. Not only engagement when you say, you know what, as an asset manager or as an institutional investor, I own X company, thousands and thousands of company, and I engage with all of them, and this is my engagement process. But maybe some product where you will have to explain how engagement is done and how it interacts with your investment decision, etc. So probably this is also something where we should see some innovation in the future.
Okay, thanks very much for that. I would like to briefly touch on the fact that obviously most investing in listed equities or products that invest in listed equities represents secondary capital. And rightly or wrongly, the perception among many is that secondary capital is relatively powerless when it comes to funding specific projects or investments with particular outcomes. So could this perception be a barrier to adoption of listed equity products? Is that something is that perception something you agree with? Maybe we could start with Laura.
No, I think it's that perception is a misconception, because to me the secondary market is in fact the most important market, because it's where the information flows. It's how we get pricing information. It's how the institutional investors really have an influence on what companies are doing, and the secondary market is changing the cost of capital for the managers. And so in that, if you think about the secondary market, not only through its pricing mechanism, but also through its information mechanism, is providing much information to investors about the managers about what investors think of their activities, and in particular ESG activities.
Okay, thank you. John, do you have any thoughts on this?
Yeah, we don't do a terrible amount on the asset side, the physical side. I do agree with Laura's comments. Price discovery, incremental cost of capital, and let's not forget what we're not talking about. Reputational risk is very transparent in the secondary market. So I'll leave it there. I liked Laura's comment.
Okay, Hervé, do you have views on this? Secondary capital versus primary capital debate or issue?
Yes, and here again, I fully agree with what has been said. If I will add probably a remark. I think that this criticism of secondary market does not have any impact, because when I buy a share, someone else is selling it, and vice versa. Is mainly a criticism which is coming from people that do not want to integrate ESG, and sometimes they have the opposite objection, says we cannot integrate ESG because let's imagine if everybody stop investing in bad ESG company, it will block access, capital access, it will be a boycott, and it will have a massive impact. So no impact or massive impact, secondary market, let's choose, but do not do please the opposite criticism when you do not want to integrate ESG. And there is something else I would like to add. Of course, so it has been said, price discovery, capital allocation. There is another factor which is very important, I think, in secondary market is alignment of interest. This is here if we want to have an impact, secondary market is where are the flows, is where the top management of big companies speak with their shareholders. If they speak with shareholders that only care about financial return, I will have a big doubt that they will strongly integrate environmental and social incomes in their business plan, in their strategy. So yes, of course, it could have a massive impact to have a secondary market where environmental and social outcomes are as important as financial outcomes, because it changes the mandate you give to the executive committee, and then it could change what is happening within the company.
Okay, thank you. I'd like to give Carolina a chance to have a say on this secondary capital versus primary capital debate. Do you have strong views on this?
No, I completely agree with the comments made before. It is definitely where we can have an influence. This is where the engagement, this is where actually the divesting of the active world plays a big role on companies to put pressure on the transition. So I would say actually this is an important playground for actually to play and have an impact in, I would say that's where really the asset owners, the asset managements really play in influencing companies on the transition. So actually it's extremely important playground for us.
Okay, thank you very much for that. So I would like to turn our attention to reporting, reporting by fund managers on their portfolios, on their products. Now, my question is, how can listed equity asset managers improve reporting and transparency around sustainability outcomes? Hervé, can I start with you?
Yes, there's many ways, but I think if we want to improve your reporting, you have to invest in a expert research, and you need to stop to believe that one day you will have quantitative data coming from external providers with a perfect fit that will help you to do your impact reporting or your carbon data. So a lot has to be done. I would say that the first issue, and coming back to what I already said earlier, is to make sure that which kind of data are we speaking of. I think that what our asset owners are expecting from us is a development of impact reporting regarding how my investment affects sustainability issue within the economy. And so I think that the first thing we have to do is to engage with different regulators, data providers, etc., to say, hey guys, this is the only thing that we need. We do not need specific data to measure how it could affect the EBITDA or the DCF calculation, etc. We need data that explain how this company affect environmental and social issues. And when I say data, it's quantitative data, but it's also the qualitative opinion, the metric. We need to have a common narrative and a common standard. For the time being, within the industry, you have data experts that say, I do not have any opinion why you are looking at ESG data. So I will provide you with dozens of ESG data and choose what you want within it. So I will say this is a parallel of how do you want to develop a report on solvability. If you want to measure solvability with people saying, okay, I have the data on the liquidity ratio, on the solvability ratio, and many other data, but at the end of the day, is it AAA, AA, BBB company? I have no clue. Use this data how you want. So I think the main issue we have is to engage with different regulators around the world and different data providers to make sure that we need impact reporting for our clients, and they need to work on environmental and social data or opinion that evaluate the impact of companies. And finally, we say, once again, if we took the example of climate change, it's just crazy that on this kind of issue, we are not yet able within the industry to agree that when we look at a company that is impactful in terms of climate change, we need to develop scope 1, scope 2, scope 3 emission data. We need to measure avoided emission to measure the ability to the company to solve the issue. There is still non-consensus even on climate change. So I think we need a collective effort on impact reporting.
Okay, thank you very much. John, do you have views on this?
So I probably had two main thoughts. First, around Hervé's comments around format and cadence of data reporting. For a specialist manager like Trillium, we're obviously reporting to our clients at least quarterly on the fundamental side, if not earlier, but also impact once a year. As I talked about, it's very important to have a matching principle about if you're fully integrated, how are you measuring? And so we'll report by strategy, metrics versus the benchmark or versus whatever constituents our clients want. Some of the big rating houses, some of them like to see our portfolio stack up against performance of specialist benchmarks. So we'll do that. We're a very transparent organization, as you'd suspect. So that's going to happen more frequently for folks that haven't done it before, in our opinion. I'd like to just change the question, if I could, to, we're talking about data, and I'd like to change the question around in transparency. And so I think maybe Laura or Carolina were talking about active ETFs and some of the new products that are coming. Active ETFs, some folks are reporting daily holdings. And so if we're moving to a world with more transparent data more frequently, how does the ESG manager, how does the impact manager like Trillium deal with that? Are we ready for transparency in all aspects to our intermediaries, to our clients? I actually think ESG managers need to spend more attention there. Do you vote your proxies and just replicate them across strategies, or are they being very dedicated? We, not surprisingly, have a dedicated advocacy team that does not only engagement, but also helps inform proxy voting. And so that's the next tranche of issues that managers will have to encounter is, yes, I've reported to you, client, that I represent, that I do this particular aspect of investing. But the bigger question is, well, how did you vote? How did you change capital? How did you change behavior in that company? We're a boutique, so we do it ourselves. But that's an issue maybe we'll come back in a couple of years and talk about. Breaking apart some replication of proxy voting will be an issue for asset managers who aren't thinking about it.
Okay, thank you. Laura, can I turn to you in regards to how you believe listed equity managers are likely to, improve reporting and transparency?
Well, I think that Hervé and John have done a really nice job of talking about the issues. I think that just thinking about the difference between mandatory and voluntary, and whether it's mandatory or whether the end investors demand so much that it just becomes voluntary for that kind of reporting. I do think we'll see more reporting coming up, and besides perhaps carbon footprint of portfolio, we'll have something like the social footprint of a portfolio, if we could ever define what social means. So yeah, I think that there will be a lot more transparency around investors' portfolio decisions.
Okay, thank you. And Carolina, I'll turn to you now, but I would also like to supplement that question with an add-on bit to that question, which is, what do you think will be the key drivers of reporting changes? Is it going to be pressure from asset owners? Is it going to be the initiative of asset managers that want to show leadership in the space? Or is it going to be the pressure of coming from the regulators, or a combination of those?
Michael, I think the key points have been made. There is too much data and around, and we need to be very careful. And Hervé made it the point very nicely that you cannot allow the portfolio manager. Think about ourselves. We have many different portfolio managers, so you cannot have everyone deciding how they report the credentials, because at the end of the day, it will be impossible for the investors to understand. And so the first thing is choosing one metrics, whether sustainability risk, climate risk, impact risk, that applies to all the portfolio managers on equities. Now, when you think about that, there is some metrics that exist on third-party providers, but the problem we have is that we don't know exactly how they're computed, so we don't have the transparency. So the problem is we had to rebuild it ourselves, and this was a huge cost and a huge effort to do that, right? And what everyone is doing is effectively, because there's not a standard yet, we had to build it and then apply that rule, so use the same rules to effectively demonstrate the credential across the border, so that, as now I was telling you, we're talking about the third dimension with impact. I mean, it's a nice sentence, but I will tell you, we are going to report across all our strategies across that dimension. And as John was saying, we will put the impact alongside risk and returns. So the benchmark will remain the same financial benchmark. And so how then you gauge those components? And I think there'll be more and more pressure, Michael, to one day there'll be metrics that will be consistent and everyone is kind of adopting it. I would say this day is not tomorrow. And so in the interim, we need to understand the risk and actually take our clients in their journey of impact. And so we are all trying to contribute. And it is true that it's probably one of the areas where I've seen much more collaborations from different players to try to create a standard. And people are aligning to this common cause. But it's not easy to come up with a standards. In it, of course, climate, everything being equal, is easier. Then if you think about social inclusion, it's open up a completely other dimensions. But we're all very focused on that, and we exchange a lot of what we're doing with each other and figure out how we create sooner than later more of a consensus for us to a standard for us to use.
Okay, no, thanks very much for that. We do have a question from the audience, which is, do you think that investors price environmental policy risk rather than environmental risk? Would any of you like to volunteer an answer to this? Yeah. I guess it depends on specific circumstances. But Laura, maybe you want to have say something about this.
Yes, I think that investors do differentiate those. Just to take climate risk as an example. My co-authors and I did a survey of institutional investors about how important they thought the different types of climate risk were: regulatory risk, the technological risk, which a lot of people just say transition risk for both of those, and the physical risk. And I think from our evidence, investors very much do separate the different types of risk.
Okay. Anyone else?
Yeah, I'll just comment quickly. Yes, it's again back to temporal policy connotates many years, depending on what zip code or domicile you're in. Some of the risks much more cogent around predictable, reasonable, in a short-term disclosable. So there is always this tension between short-term and long-term, and that's how I interpreted this question. Policy takes a while to change. Okay,
excellent. Well, thank you very much for all your answers, suggestions, and thoughts. So I thank all of you panelists for taking part in this session. I would also, like members of the audience, for the questions they've submitted. And I'd just like to say that this is the last PRI Digital session of the day. PRI Digital continues tomorrow. And we're looking forward to welcoming you again tomorrow. So thank you very much.